Good morning. My name is Chris McIntyre. This is our first time together. I joined earlier this year, and I am the institutional client guy, which means it's my job to bring a little bit of energy into the room. I think I have maybe the best job at Apollo in a way, because I get to represent our amazing platform. And just by way of background and a little bit of a confession, I'm an asset management geek. I spent the last 20 years working in this space, working on this space. Over the last 5 years, I was the head of asset management in North America for the Boston Consulting Group. And my literal job was to go find winning business models. I think you can see where I'm going with this one. So I think I found home. And I, for one, feel very privileged to get to do this. So let's talk with some numbers. If I have one message for you, it's the number 2. The numbers on this slide, we're going to double growth in our segment of the business over the next 5 years. That's a choice. As we've talked about, we are not constrained by capital formation. We are only constrained by our ability to originate great assets. We're going to do that for, I think, 3 very straightforward, compelling reasons. One, we're going to be talking about doubling our addressable market. You've heard about this today. We're an incumbent in alternatives. We'll continue to win there. We're also going to invent a whole new space over the course of this next 5 years called replacement. We'll talk more about that. We have 2 big growth engines, one on the alternative side, one on the replacement side. We'll talk about that. It's a spring-loaded portfolio we'll talk about in just a minute. And then we've already doubled down on our capabilities. We saw this moment coming. So we've pre-built the team. Some of the stats that Scott shared a few moments ago about the team, the capabilities that we've started to build to serve our clients to win these kinds of outcomes. But I have to say, this capital formation is really, I like to call it an earned outcome. It's not a right, it's an earned outcome. And it's an earned outcome of everything you've heard up to this moment about the uniqueness of the Apollo platform. It's proprietary origination. You heard the number 4,000 people. Go look up the head count of most of our peers. This is just origination, right? It's product innovation, not just any products. We're not a product supermarket. We choose very carefully where to offer products to our clients because we are deeply aligned with them. We have our own balance sheet. When we win, they win. When they lose, we lose. So our interests are highly aligned. That sets us up for great client relationships and allows us to achieve, we think, these kinds of numbers. So I mentioned I'm an asset management wonk. I think it's important to tell the story of why we are all in this room today at this moment in time, actually, and it goes back 100 years. So this is the history in illustrative terms of the institutional segment. Started off in the early days, the foundations. Basically, you could achieve your goal, the 8%, by owning fixed income. That's all you needed to do, right? That was the era of return at no risk. It's a good time. Didn't last very long. Then we go through the 80s. Rates go up, rates start to come down. The need for equity exposure emerges. Public equity markets develop. All of a sudden, the 60-40, which we all come to know and love, emerges, right? That was the era of return with some risk, mostly equity risk, as it turns out. What we've just lived through, and most of what we've talked about today, is a very unique period, which I like to call return at any risk. Almost by structure, all of our institutional clients who have basically that same 8% goal had to stretch. Why do they have to stretch? Because of the picture on the bottom. The risk-free rate, which I like to say risk-free is destiny in institutional investing, hit the floor. Mechanically, not by choice, mechanically they had to go up and to the right. Alternatives, 0 to 20 in 20 years. It was a necessity. What also happened? We printed money, passive. Why did that do so well? The period between last year and the 10 years prior was one of the best 10-year periods in public market recorded history. You had to do nothing. It was great. I mean, it was great for savers. It's tough on the industry. So, as we've talked about extensively, we're no longer in that world. That world ended a couple years ago when rates went back up to normal ranges we've seen in our lifetime. We think that is going to mark the beginning of what we call a 4th evolution or revolution in the institutional marketplace. I like to call it the 4th replacement. As you can see, each of these has been a replacement of an existing technology with new technology. Here, we think we're going to start to think about Not return at any risk, but importantly, as you've heard today, return per unit of risk. That's the new mantra, right? Every single CIO we speak to is re-examining fundamentally where they want to earn their return and where best to take that risk. The bar for the whole industry has gone up, big time. We think we're well positioned to take advantage of that. That's point one. Point two, the idea of liquidity is being fundamentally re-examined. Mark talked about it. Investment grade bonds, we can already see it. You already see it a little bit in private equity. There's a thing called the secondary market. Where did that come from? Right? We're also going to start to fundamentally revisit this idea of public being safe and private being risky. We think this is basically the definition and the future of the asset management industry for the next 20 years. Obviously, we're excited about it, and we'll talk more about why. So let's talk numbers. We've got a lot of analytical folks in the room. What does this mean for our industry? If you look at the institutional-only asset management industry and alternatives, it's about 20 trillion as of last year, plus or minus. If you add up all of the active management in public and fixed income, it's almost exactly 20. Coincidence? So our TAM, from our perspective, is doubling. To achieve our numbers I just showed you on this page, all we really have to do is keep our market share plus or minus a little bit in the bottom 20. The rest is upside. We're going to go get it in this period, but it's all upside. So we're exceptionally excited about both of those opportunities. You're going to hear us talk a lot about that over our subsequent conversations together. So let's talk about us. We have two big growth engines. Engine one, which you've come to know, alternatives, where we are going to differentiate. And in replacement, where we're going to innovate. On alternatives, you can see we have credit and equity. The team has talked extensively about that, including real assets. These businesses are 15, 20 years in the making, $8 billion of investment, 4,000 people, $150 billion, $200 billion of origination. You can't just show up and replace that. That's as good as it gets in competitive advantage in asset management. And our equity business, 35 years of private equity, excellence. And by the way, DPI, who knew? That'd be the new IRR. The guy showed the numbers. It's 2x the industry. We're actually doing what we said we're going to do. When we come back to market, you're going to hear us say that loud and clear. We think we're going to win. On the replacement side, some coded language in there. Private investment grade. How's that going to happen? You heard it. Market making, fixed income, investment grade, private, origination, coming together in packages for solutions where we can show up to a CIO or head of fixed income and say, would you like 200 basis points for a little give up in liquidity? Very compelling. And the good news is this is already happening. This is not just talk. $10 billion of assets into fixed income replacement related strategies already, 9 consultant approvals. As we've talked about, the reasons are mechanical. People have been in the red, they're moving to the green. That explains basically the movement of private credit, and we're going to move them up to replacement. Higher return per unit of risk. That's the equation. Finally, as I mentioned before, we saw this moment coming. We've been preparing for many, many years. These are all numbers that we've already invested in the business. You can see the date of 2020. So we're preparing for this growth for the next several years, and we think we're ready to go. Thank you for your time.